Hello, everyone. My name is Joelle, and I am the program admin here at Shenandoah Community Capital Fund. In this session, we're going to talk about cash flow projections. We'll cover how to create a cash flow projection and how to analyze a document to better understand your business or business idea.
Hi, my name is Kristen Wong. I'm the microfinance director here at the Shenandoah Community Capital Fund. By the end of this session, you'll have learned how much cash you can expect to generate and spend on a monthly basis. If you have any questions about cash flow projections or the small business microloan program that we have here at SCCF, please feel free to reach out to us on our website, and the link is in our description as well for more information. The template we'll be using today is also linked in the description.
Awesome. So we'll start with some general information. So cash flow projections are a key part of your financing proposal. So if you're ever going to want to apply for a loan or apply for any sort of financing, they're going to want to know how much money is that you plan on making, and that's actually pretty realistic. The cash flow projections illustrates the cash that you expect to generate and spend on a monthly basis. It shows you how you plan on using the cash through your business.
Projections also help keep your spending under control to be able to see how much cash in and how much cash is going out of your business on a monthly basis. Just helps you be able to expect like what to expect monthly when you're looking at the next year for your business. And you can do a projection for more than 1 year, but that's what we're going to just be looking at today is for 1 year. It also allows you to run what if scenarios. Let's say one season you think is, you're going to have a lot of sales, but you also want to run what if the sales are lower than I think they're going to be. You can always run those different projections, just change the numbers and be able to know sort of like worst case scenario, best case scenario, or like the middle ground as well. So that's just helpful a little bit about cash flow projections and just to be able to have that as we go into this template. So I'm going to share this template that we're going to be in for the next bit. First of all, we have a template for the startup expenses that is going to go into your cash flow projection. So if you're a startup or you're a business that's significantly expanding, you're going to want to do these initial expenses because they're not every month expenses. They are needed for your startup or your expansion, and they're one-time expenses. So make sure any expenses that you are putting in this startup expenses tab that they're one-time expenses. It doesn't mean they may keep recurring, but we don't put those here. These are the one-time expenses that have to happen for you to start or expand. So here you can put the numbers in. If there's something here, feel free to always delete it. Let's say you don't have a deposit, delete it. And you can always just delete that row as well. What this does for us is adds up all of the startup costs and has it here in row 33. The 29,750 are the startup costs that are listed here. And then you also want to put your desired cash on hand. So after all of these expenses, these one-time startup expenses are paid, how much do you want in your bank account to start your business? So come down here, this person wants $10,000 in their bank account as desired cash on hand. And then the next line is taking the total startup cost and desired cash on hand and adding those up. So that's the total need for the startup. And the next line, you can input the owner's injection. How much are you financing of your own funds, or if you're expanding business, of the business's funds into the business? And then down here, it takes a total financing need. So it takes the total needed minus owner's injection for total financing needs. So that's how much you need outside of what's already going into the business. So here it'd be the 33,750. So now that we have the startup costs, we're going to move over to the cash flow projection template. And here you can see that it goes month to month. And here, up here, we have like cash in, and down here we have operating expenses, cash out. So first thing we're going to look at is cash in. How do we put those numbers in? So here we have number of clients per day. They're estimating 6 to start with, and you can see they have the seasonality here. So not every month is not going to be the same with your sales. So you want to project that to make sure your sales projections are the most accurate that they can be. And then you have your average customer check, and then also the number of days that you are like open that month. So here they already have that inputted, and I want to show you how that sums, like how it sums up and comes down here to sales receipts. So here on row 12, sales receipts. And if you look at the formula, it's the C3 times C4 times C5. So it's adding or multiplying those up, and then you're able to get the sales receipt. So it automatically does that. Because it is a template, whether you're using like Excel or Google Sheets, just make sure it is consistent. If you see 1 month that's like, this does not look right, just make sure, check and see what the formula is. Make sure it hasn't done something funky. You don't want that to mess up your numbers. So just in general, just make sure you keep looking and making sure the formulas look like they're working. So that's the cash in. And remember, cash in is any sales receipts. So it could be credit card, it could be cash. If you take Apple Pay, any of those ways that you are receiving you're getting sales receipts, then that is what would be included up here. It's not just like physical cash. So we're going to keep going through this. So Joyelle is going to go through the rest of this template.
Thank you. Okay, we're going to start in row 15 with your cash available for use. You need to see your cash available for use is literally how much cash that you have within that month, from the start of that month to the end of that month. And this is a combination of your sales receipts. So how much revenue did you make that month? That's how much money that you got in. And it also includes if you were to receive a bank loan, if you were to receive a grant, you see in row 13 right here in bank loan, this person received a bank loan. So that's an influx of cash that they are able to add to their cash flow projections. And so if you receive anything like that, that's something that you can add in yourself, and you can change it. It doesn't have to be a bank loan, just change it so that it most reflects your business. And then also up here, like Kristen was saying, the cash on hand at the beginning of the cash on hand at the beginning of their period, which I'll talk a little bit more about later on how you get, it's also added in this number here, your cash available for use in each month. And I do want to just highlight that it's really important to do your best on being realistic with your numbers. It's always good to hope for the best for your business and desire that you're going to get like a ton of people into your business or purchasing these products, or however your business is structured. But it's best to just be realistic with those numbers. And one of the ways that you can do that is go to your local SBDC, and they have market research that you're able to figure out like how many people walk by your business, how many people are in the demographic of your area that are in your target market. These are things that you're able to figure out so that you have research to really back up your numbers so that they're strong, and so that it'll work better for you as well. Also, right here, you have your operating expenses. So your operating expenses are basically the expenses that you need to keep your business afloat day to day. And these include like your inventory purchases, rent, insurance, telephone bills, just these day-to-day expenses that incur. And so here I want to point out inventory expenses in row 19 that they change. So here you see in June, they purchased $15,000, or Yes, they purchased $15,000 worth of expenses. And the next month it's $12,000, and the next month is back to 15. So this is reflecting how they're not going to need the exact same amount of expenses each month. So that means it's going to change how much cash that they actually have at the end of the period, because it accurately reflects how much cash it took to purchase those expenses. So when you're doing your expenses, that's something you can also take into account. It's just the changes in the seasonality and the differences in your expenses. For example, that is an expense that changes, but your rent's most likely going to stay the same. So that's something that you can also reflect here. You see that in row 29, the rent is 800 and it stays 800. Also really important in this row right here, you see all of your totals. So you can see how much money you're spending on something at the end of your fiscal year. And if you want to cut your budget or you want to move cash around, this is a really cool tool that you can use to see how much you're spending in each section. And then down here, here's your total cash paid out within that month. So how much money did you spend that month on your rent, on your inventory, on your taxes? It'll be right here in the total cash that's paid out. And then we also have your cash on hand at the end of the period, which is in row 52. So this number is your cash available for use, which you spoke about earlier, and it's subtracted from your total cash paid out. So your total cash paid out is subtracted from your cash available for use, and then you get the cash on hand at the end of that period. And what's really cool is that this is a number that you have at the beginning of the next period. So here in June, you see you have $11,000 at the end of June. So you're going to start July with that same $11,000. So that's how all of these numbers flow and work with each other. And yeah, so just to reiterate, it's just really important to be as realistic as possible with these numbers, really reflect seasonality. For example, if you know during the holidays that you get an influx of business, you can add that in and you can expect to have that extra cash. So you know that, oh, I can hire another person when business picks up, and things like that are able to be reflected on this sheet.
We're going to go on a blank document now just to show how to input these numbers, since this example was already filled out. So let's move over there. So I did add a couple numbers just to make it easier as we went through it today. But we'll start again. The startup expenses are moved over here. And it's a different, they're different numbers, so they're not the same as the template that was filled out that you were just looking at. And again, just make sure that if your expenses or your startup expenses are longer than what fit on here, just make sure they're all on here. Just make sure to check the template. If there's a whole bunch of expenses, they don't always all go over here, and you have to just add a row and add it yourself. So just wanted to make a note of that. So we're here, startup expenses. We also have the bank loan. So that's the cash injection, and then also the owner's injection is showed as a $5,000. So we're starting with the $20,950 cash available for use, and then the cash paid out is $15,950 from these startup expenses. And then that means the cash on hand at the end of period is $5,000, which is what I had put in this template that we wanted to have cash on hand to start. So we are going to go up here to put cash in first. This template has a lot of blank spaces up here that you can add however you do sales, the products or services. There may be, just one. You just have number of clients, average customer check, and number of days. That's fine. But sometimes there's multiple different revenue streams. So that's why there's so many. But you can definitely just go ahead and delete the rows as needed, or just leave them blank, either or. I have one filled out here, and we're going to add another one together. Here, you can also change like it says number of units per time, but I changed it to number of clients per day. And we have professional headshots. And here on line 27, we have the family portraits. So I have it broken it down into two different services that this business provides. And I already inputted the number of clients per day for the family portraits was 5, average customer check, $250. And the number of days a month, since this is by month, is 5. So you do want to look at seasonality, which is already in here. There's a number of days. There's only 8 in August. And there, it increases to 9 September through December, it goes back down. And that can look different services at different times, you're selling more. So we're going to input here 25 clients per day. And one nice thing in this Excel or Google Sheets, you can come down to the bottom and scoot that over so that you can see, so you don't have to type in the same thing the whole time. Here we have 50 clients that month. And then we have 40 for the rest of the year. So there we go. And average customer check stays at 20. That's how much they're charging per headshot. And can move that over. Perfect. And then the number of days per month that we are expecting to have the service. So here looks like they're starting out with 8 days per month. And then when the other service increases here, they're decreasing this service a bit. 5 days a month they expect to do professional headshots. And then the rest they anticipate headshots to pick up in the wintertime and be 10 days. So we can go ahead and put that over here. Okay, so we have that filled out. We have information about our sales in, or a cash in. So let's talk about cash out. So we come down here and I inputted numbers this first month, but we're going to drag them over. So we have advertising. Advertising is a monthly expense. So we are going to move that over. The automobile, so like gas, and that would have seasonality with it. So you'd want to look into that too. The more you're traveling, that could change month to month. Insurance. So in this case, insurance is being paid quarterly. So you can just input it in the months that it's being paid. So that's one of the nice things. Put that in the wrong place up here. One of the nice things is just that you don't have to do only expenses that are monthly, but you can see when they're going to be due and make sure it's going to be okay for your cash flow. So I think over here. Okay, so that's a quarterly expense. Office expense, that is going to be every month. So we just drag that over. Salaries, every month. Now, depending on the services that you're providing, it could very well fluctuate. But just in this example, I'm going to use that amount. And the same with payroll taxes. And then taxes and license, we're going to also have, we pay this quarterly. So we can just type that in quarterly and it will make sure that we'll be able to see if we'll have enough cash to pay those expenses. The last expense here that we have is debt repayment. Since it did have that, we were taking out a loan. I'm going to put that over here since that will be a monthly expense. So we have all of our expenses in. And so I just want to show what this shows us as a whole. So we come back up here, we see our sales receipts. It is adding all or multiplying all of those correctly. And it shows our cash available for use at the beginning of the month. Then here we come down and there's total cash paid out each month. And then it takes the cash that you started with the month with minus this cash paid out, and then gets you the cash on hand at the end of the period. So here in line 76. Now I do want to show in this example, the cash on hand at the beginning of the period, we can expect that in August, we're going to have a deficit of $1,100. So this is where this is common when you look at cash flow projections. So if it's in the parentheses, it just means it's a negative number. There's just different ways to be able to problem solve that. Maybe you cut expenses the month before. Maybe you're able to have a line of credit and be able to cover that gap, or just be able to get 1,000 more financing and know that you're going to be covered for the year based on your projections. So that I just wanted to point that out. And then, as Joelle had mentioned earlier, you can see the totals for the year here. And then what I think is very helpful as well is if you look in this section, the last month of this projections, you're able to see how much cash on hand, just here, have at the end of the period. So you can expect to have the 58,900 at the end of the period. So that's what you would start the next year on. That is about all with cash flow projections. Really just making sure you're putting cash into the business and cash out, and you're able to see the available cash per month and be able to expect each month.
Awesome. So we have a few more pointers that we want to share with you guys. First one is to just remind you guys to be as realistic as possible with your numbers. And some ways to do that are you can reach out to other small businesses in the area who have similar business structures as you do. Ask them how they calculate their accounting numbers, or how they account for seasonality. These are just different ways that you can be as realistic as possible with your numbers. And also looking up different subscription services and just using those numbers in your projections to anticipate how much things could cost. Also, it's a really cool tool you can do with this is you can create best and worst case scenarios. So for best case scenarios, if you know that you're going to need to buy more inventory because you are going to have more customers, it's something you can prepare for, and it can be reflected in which month that's going to happen in this cash flow projection. And also worst case scenarios, the weather sometimes is bad, or there's like a storm and people don't come out as much, or just different things like that can happen. You can also have that reflected in your numbers. You can just drop the amount of people or drop the amount of money you can charge for a product, and then you can prepare best for that rainy day in your business that could potentially come. And also, just a few reminders, remember to factor in seasonality, any special events or promotions that you may have, any new products, and any planned pricing changes. These are things that you can also reflect in your cash flow projections, and you can see what effect does this have on the cash. And also, it's important to know which of your costs are fixed and which are variable, meaning which ones stay the same and which ones change, and how that affects your revenues. So like we said earlier, like your rent will probably stay the same versus your inventory could change just depending month to month. What are the requirements of what you'll need in each month, and then it's just reflected in your revenues.
Also know that when you are applying for financing, this is really helpful to be able to have any financing application for a loan is going to ask for cash flow projections. So having this ready will help you be more prepared for financing. So remember your cash flow projections and your cash in and your cash out of your business, and hope you were able to learn how a cash flow projection can help your business and help you understand what's going on in your business and help you be able to project that and be able to be prepared. How much money could you make? Hope you were able to learn that today. The template will also be linked to this description, and then also more information about our loan program here at SCCF for small businesses and entrepreneurs. So thank you again for listening in, and happy cash flow projections.